Howdy everybody and welcome back to another stock analysis video. Today we are going to be doing Dick's Sporting Good. I love Dick's. The fact that they have like a bunch of sportswear and footwear, depending on if you really do enjoy the sporting, then you should also love Dick's as well. Their earnings are actually coming out March 8th, which is, as of I'm recording this video, tomorrow at 7:30 a.m. I'm probably going to put this video around maybe like 10 or 10:30. Just to see what price we should be buying this company at, and maybe depending on how their earnings come up, maybe it would be a little bit more juicy of a buy depending if they go down or up. So with that said, let's get started with this analysis. Now starting off, before we analyze Dick's, we first need to look at their dividend summary. Dividend yield of 1.6%, which comes out to be 44 cents a share for an annual payout of $1.75. Payout ratio in regards to the net income, 10.18%, which is pretty good. Double digits is really good. 5-year growth rate on this dividend is a whopping 21.47%, which they have been able to increase over the past 7 years. Now, just because they have been able to increase it for the past 7 years with a 5-year growth rate of 21.47% does not mean that they are able to afford it. Normally, the payout ratio would tell you this. However, this payout ratio is in regards to the net income, not the cash flow. Companies use their cash flow to pay out dividends, not net income. So we're going to take a look at Dick's payout ratio in regards to the cash flow in just 1 second. Ex-dividend date was December 9th, payout date was December 29th, and they pay their dividends quarterly. Now coming over here to the spreadsheet, ticker symbol for Dick's is DKS, market cap of $8.6 billion, PE guys of 7.69, which is actually really cheap. Now the current share price being $99.50, pretty much just telling me that according to this PE, which involves their earnings, is telling me that this is a pretty good decent buy. However, we're going to take a look at other metrics and see where this company lies in regards to the revenue, their cash flow, their shares outstanding, etc., and come up with an even more accurate assumption. Now, they do pay out a $1.75 a year for their dividend, which ends up being around $144 million being paid out every single year. In relationship to the 5-year free cash flow, they are still left with around $386 million after this dividend is paid, which comes out to be a payout ratio in regards to the free cash flow of 27.18%, meaning that they can 100% afford this dividend. However, just take a look at this, guys. The fact that their 5-year free cash flow is in the millions and not in the billions is something that, to be fair, this is a retail store, so it's kind of understandable. However, even though the payout ratio is 27%, I would prefer it if the average 5-year free cash flow would be around $500 million after the dividend is paid. But nonetheless, they can afford this dividend and even increase it into the future. Now let's head over to the fundamentals for Dick's. Net income of 5 years ago, $287.4 million to 1 year ago of $530 million, which is an increase of 85%. Something very interesting, guys, is that 1 year ago they just completely shot up. 2 years ago they only made around $298 million, and the previous year, 3 years ago, they did around $320 million. What caused this huge increase in the 1 year ago mark, I don't necessarily know. Now, normally I would assume that this would be a COVID number. However, if we actually take a look when this data was actually taken, the 1 year ago data is actually taken from January 2021. So this one encompasses all of 2020, so I don't necessarily know why their net income actually went up in 2020, whereas the previous years it actually stayed pretty much the same. Now let's take a look at the free cash flow 5 years ago of $347 million to 1 year ago, guys. Look at this explosion of $1.3 billion, which is a massive increase, guys, of 283%, which is a 5-year average free cash flow of $530 million. The fact that this occurred pretty much in the same way that the net income occurred, obviously the free cash flow exploded a lot more than the net income. However, just take a look at this. I have no idea exactly what caused this huge uptick when it comes to the free cash flow. Definitely something to take a look at their 8K and 10K to figure out what caused this. Me personally, looking at this from a 9,000 foot view, I have no idea what caused this. It is definitely an outlier. Can they continue this into the future? I don't necessarily know. I do know that the reason why Foot Locker went down in price a couple of weeks ago is because Nike decided to actually pull all of their shoes from third-party stores, which include probably Dick's and, of course, Foot Locker. So How will this affect Foot Locker tomorrow? I don't necessarily know, but definitely something to take into account. Now let's take a look at the revenue 5 years ago of $8 billion to 1 year ago of $9.6 billion, which is an increase of around 21%. Pretty steady increase when it comes to the revenue. Couple hiccups here and there on the 3 and 2 year ago mark. However, it's essentially a nice steady increase just on average. Now let's take a look at the total assets and liabilities. What this metric does is it simulates if the company were to liquidate all of their assets, would they be able to cover their liabilities? And how much money would they have after doing so? Currently, Dick's has around $1.4 billion left if they were to do this. And not only that, guys, something to see here that's actually might be an indicator for the previous metrics as well, mainly the free cash flow and the net income. 1 year ago, they were very positive at $1.21 billion, and then today they are even more positive at $1.4 billion. If you take a look at the 2 year ago, 3 year ago, 4 year ago, and 5 year ago, they were pretty much around the $500–600 million mark. And then once again, 1 year ago, just like we saw with pretty much the free cash flow and the net income, it just completely skyrocketed. And the fact that this year they continue to skyrocket might give you an indication as to where the free cash flow and net income are going. Does this mean that it's 100%? Not necessarily, but it is a pretty nice indication. Average total assets is around $2.7 billion. Average total liabilities around $2 billion. Average assets minus the average liabilities comes out to be around $786 million. Next, let's move over to the shares outstanding. This, guys, is the silent killer when it comes to investing. You want this number to be going down, not up. And this number right here pretty much shows as to what the share price is actually going to be once we use the discounted free cash flow calculator. Because if you guys didn't see my video from yesterday where I go step by step as to how this calculator works, one of the very last steps is after the market cap is calculated using the terminal cash flow, we then take the future projected shares outstanding and divide that by the market cap. The more shares that you have outstanding, assuming that they are diluting you, the bigger the denominator, therefore the share price will go down. The smaller the shares outstanding, then the denominator will get smaller, therefore the share price will go up. Essentially, this is the silent killer. The more this number goes up, the more they are diluting you. When it comes to Dick's, well, 5 years ago, they had around 110 million shares to today, guys, of 82.3 million shares. They have bought back within the 5 years at a whopping 25.39%. And not only that, from the previous year to the current year, so from 1 year ago to today, they bought back around 3.06%. Which is huge. Now, 2 years ago to 1 year ago, they did increase it slightly, but then they brought it back down even below that of the 2 year, which is a really good sign. They are buying back shares at a good rate. In fact, they're buying back shares at a way too much good rate. At the rate they're doing it, we may not have shares to buy into the future. And lastly, we got the cash equivalents. And as of today, Dick's has around $1.4 billion in cash equivalents with an average cash equivalents of $580 million. Now let's make some assumptions. Low, median, high, you know the drill. 3 different factors: growth assumption, projected share buyback, and required rate of return. For the required rate of return, I'm going to keep it the same at 10% for all 3 assumptions just to match the S&P 500. Now, for the growth assumption, I'm going to be using Seeking Alpha's revenue growth year over year and the revenue growth forward and aim somewhere in the middle. For the projected share buyback, I'm going to use the graph that we just saw with the projected share buyback. And in doing so, for the low assumption, I'm going to assume a growth of 20%, projected share buyback of 2%. This comes out to be a target share price, not adjusting for debt, of $158.13. For the median assumption, growth of around 23%, projected share buyback of 3%, which is what they did from the previous year to this year, we get $175.11. And lastly, for my highest assumption, I'm going to assume a growth of 26%, projected share buyback of 4%. We get a target share price of $193.55. Now we need to adjust for debt. And the way we do this is we take their cash and equivalent and we add the net debt. If they have more debt than cash, then obviously this number will go down. If they have more cash than debt, then this number will go up. As you can see right here, they have more debt They have more debt than cash. Therefore, for the low assumption, it comes all the way down to $137.27. For the median assumption, we get $154.04. And for the high assumption, we get $172.26. Now let's add a margin of safety. A lot of people ask me, why do this? Well, the reason for it is because let's just assume that you're building a bridge. And you know that bridge max capacity has to be 10,000 pounds. The thing is that when you build that bridge, you do not make it for 10,000 pounds. You make it for 15 or 20,000 pounds because you want to compensate for any issues that you may have into the future, right? Same principles apply when it comes to investing. Margin of safety gives you a cushion of returns. The more you pay for something today, the less returns you're going to have in the future. Therefore, adding a margin of safety of 5, 10, and 15% for DICS, we get a target share price between $116.68 to $130.41. For the median assumption, we get $131 to $146, and for the high assumption, we get $146.42 to $163.65. Now guys, given that the current share price is $99.50, and for all you know, when you see this video, they could be either up or down depending on how their earnings went. I don't necessarily know how this is going to be. I'm pretty much doing this at 7:30 on the 7th, so we'll see what they do when their earnings come out. But assuming that my assumptions are in the correct ballpark and you believe them, then by all means this is an absolute buy. Now, if you believe my assumptions, I never tell anybody what to buy. What I just did here is I just showed you the raw numbers when it comes to the fundamentals, and I am showing you here what my assumptions are. I have this calculator for free. It's in my discounted free cash flow calculator video. Make a copy and you make your own assumptions. All I ask for in return, guys, is like, subscribe, comment, tell your friends, share, hit that bell. We're up to 418 subs. Would love to get to 500 by the end of March. That'd be such a great milestone to reach. That way I can start making polls, community posts, asking you guys questions like what company should we do, the earnings are coming up, etc., etc., etc. It should be really, really fun. So if you guys want to help me with that, please like, subscribe, comment. It really does help. At the end of the day, make your own assumptions. The calculator is for free. I am not telling you what to do. This is not investing advice. All in all, guys, when it comes to DICS, I gotta say, I like DICS. The fact that their dividend is actually affordable, they have a pretty good fundamentals. However, I would like it to be a little bit more consistent, especially when it comes to their net income and cash flow. It's all over the place. They had like one good year, one outlier year. If they're able to continue this into the future, this is by all means an absolute buy. If you believe that they're able to do this into the future, then DICS is a really, really good buy right now. But at least when it comes to me, I would like to see a little bit more consistency when it comes to their fundamentals. But that pretty much does it for this episode. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You can follow me on my new tech sites, BitChute, Odyssey, and Rumble. In addition to my stock analysis videos and crypto videos, you will find exclusives as well. In regards to Odyssey, YouTube, and Rumble, I have a Let's Play channel, link in the description below, where I'm currently playing through Pokemon Legends Arceus, and since we're almost done with that, I'm also putting some Bloons content as well, so if you want to catch that, the link is in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.